what's up guys? It's Ezekiel here. So let me ask you this. Ever nailed a Fibonacci level only to watch price blast straight through it? Right? You placed the two, you trusted the zone, and then boom, it fakes out and then loss. Confusion. That's not bad luck. That's bad anchoring, bad confirmation, and zero exit structure. So the truth is, most traders are losing with Fibonacci not because they are wrong, but because they never learn to use it like a sniper. Right? They are what? They are drawing lines, but I'm reading the levels. And today I'm going to show you the difference, right? Because once you lock in these 4 techniques that I'm going to show you, your Fibs won't just mark levels, right? They're going to map precision entries, powerful reactions, and profit-taking exits, right? And that's how you stop trading like a hopeful and start executing like a pro. Let's dive in. So everyone has access to the Fibonacci Retracement tool, right? It's built into probably every trading platform out there, right? You got a few clicks and your chart is now covered with the Fib lines. But the way that most traders use, it actually does more harm than good, right? They drag from wherever it feels right? They throw the levels and they hope that,
the market is going to react to this level, right?
No. One thing's clear. Fibonacci is not like magic, right? It's what? It's timing, but only when used with precision. So it's not just a number pattern, it's in nature, like nature. Because why? Market moves in waves, right? They push, they pull, they breathe, right? When the market pulls back, Fibonacci, what happens? It helps to spot the potential reversal area, right? Not because like,
oh, those lines, they are special,
but because the market moves with rhythm, right? So here's what most miss. It only works if you anchor it right? When the confirmation is clear and when the exits are planned. And that's what we'll be diving into, right? So today I'm going to show you the 4 powerful techniques that you can apply immediately. So if you ever felt like you're almost right, almost on a trade, right? Only to watch price just blow past the level, you're going to find out why. Alright, so now, technique 1 is where it all starts. Because before you even talk about entries or exits, you need to learn how to plot the two properly, right? Everything begins with how you set the foundation, right? If you get this part wrong, there's no point in me telling you how to enter, how to exit, because the structure is wrong, all right? And nothing else matters first. So foundation comes first, and that is technique number 1. The precision anchor. Here we go. Okay, so why is it called the precision anchor, right? Because the entire Fibonacci retracement tool depends on where you start and you end it, right? So your anchor points, right? You get those wrong, nothing that follows is gonna be valid. You get them right, and every level, every reaction point, every possible trades is gonna become clear, right? So it's called precision for a reason, right? Because this is not like, oh, it's a rough estimate. I think it's gonna be here. I think it's gonna be here. No, it's very precise. The Fibonacci levels, they are built on what? Ratios, numbers, exact structure. So the way that you place it has to be just as sharp, right? If your anchor is just off a little bit, you're going to read the wrong levels. And that's how like the trade, they go sideways. Even before they begin, it's going to go wrong right away, right? So let's break it down step by step. So let's say you got an uptrend, right? It's a nice move with a clean swing low and clear swing high. So most traders, what they're going to do is what? They just drag the Fib tool from the body of the lowest candle to the body of the highest candle. Why? I mean, because it's easier, or because they don't realize that how much it actually matters. Here's what they're missing. Price don't react to where the candle is closed. It reacts also to where it tried to go So, and that is what? That is the wick of the candle. That's where the real price rejection happens. That's what matters a lot actually. So the correct way is to what? Is to anchor your Fibonacci 2 from where? From wick to wick, right? You drag it from the lowest point of the swing low, of the swing wick actually, to the highest point of the swing high wick, because that is the actual range of the move, right? That's how the market actually moves, right? Anything less than that, you're cutting away the truth of the entire move itself. Next. Pro tip. For the best selection on where to draw your Fibonacci retracement tool. I mean, by default, right, we draw it at the highest point and the lowest point of that specific time frame that I'm expecting the retracement to be. So let's say if I'm trading the 1 hour time frame, and the 1 hour time frame, I got a clear cut highs, I got clear cut lows, I'm going to draw it on that time frame itself. It got to be significant. The highs and the lows got to be significant. Now, sometimes the level may not be the best precise level, right? Especially if you notice that price is not really respecting those levels when you plot the high and the lows, the highest point and the lowest point in that chart. Price is not exactly respecting those levels. So what I'm going to do is I'm going to adjust the highs or the lows to another point, moving just one. So for example, let's say if it's an uptrend, right? The highest point cannot change, right? Because that is the highest point. But the lows, along the way, there are multiple lows. So I'm going to find the next obvious low, a next significant low, and I'm going to plot the Fibonacci there. And if price respects the Fibonacci level there even more, right? You can see it clearly respects all the levels. Then you got yourself the correct Fibonacci drawing, as this is the one that the market respects. Now, this makes a whole lot of difference. Remember, foundation structure got to come first. All right, so now technique 1 is really about setting the foundation, right? So which is what we said, right? If you don't even think about pulling the trigger, right? This is the part that sets the tone for everything itself. All right, now next.
Hey guys, Ezekiel here. So most trading platforms work, but after a while they kind of feel like they are stuck in the past.
Slow navigation, clunky menus, features that haven't kept up. I mean, traders would know the drill, right? That's where MaxTrader comes in. This is a next generation platform with a redesigned interface that's modern, intuitive, and effortless to use. I mean, everything is now sharper, cleaner, and more convenient. So it is built to work for everyone. I mean, it's for traders who are just starting out to experienced pros running like complex setups, right? The navigation, it feels natural. Execution, that's the key, right? Lightning fast. And the charts, yeah, they are fully customizable and they remember your setup each time. The best part is that it keeps evolving, right? They take traders' feedback to shape their roadmap. So the new features, they roll out fast. Their Discord community plays a big role in that process. And just to be clear, MaxTrader is not a broker. It is a technology provider for brokers and prop firms that are designed with traders in mind. So if older tools are holding you back, their demo is free. Try it and see how it fits your trading style. See what it's like to trade with something that is built for now and not like 2010, right? So whether it's for live trading or platform reviews or teaching setups, right? It delivers consistent performance from actively placing trades to testing the platform or using it for training. It meets the needs for every scenario. So now, if you want to trade with edge, check out MaxTrader in the link below. Some of you is gonna ask, right? Okay, so now that, all right,
Ezekiel, I've learned.
I know how to plot the levels, right? I clean my chart, it's now clutter-free. I know Fib is important. I'm going to plot the levels to plan for to plan a retracement, right? Where is the level where price is going to react to? Now, what if I place my Fibonacci 2 correctly, but price still doesn't bounce at that level? For example, it goes down to the 50, it goes down to 61.8% level, but it doesn't bounce. Or worse, it just slices right through. What am I going to do? And that's where technique number 2 comes in. How do we know if price is actually reacting to it, right? If you don't know what a valid reaction looks like, we are guessing. And guessing is what gets most traders in trouble, right? So this is where the technique number 2 will come in. This technique is all about confirmation. What happens is that we observe how price behave as it approaches the Fibonacci levels, whether it respects them or it ignores them completely. All right, so now let's break it down. What does respect actually mean? Price actually acknowledge, it recognize, it acknowledge the level. It don't just barge right through, go right through. Like those levels doesn't exist at all. It slows down the area, it even rejects the area or it hesitates around it. We want to treat the Fibonacci levels as areas as well. Not exactly like, oh, it's gonna be like a razor thin trigger. No. You can treat it as an area. The next question is, how do we know if price respects the level? Here's what we're gonna do. We wait and we watch. Alright, so take a look at this. Price pulls back to what? The 38.2%. There's no hesitation now. What happens? It sliced right through it. There's no weak rejection. There's no bounce, which means what? There's no respect, right? Then the same thing happens when it goes down to where? The 50% level. Price just what? It's just pushed right through it. So this is your signal to do what? Stay out, right? We're gonna stay out. I'm not just gonna enter in blindly because it's the 50% level. Then what happens next? It goes to where? The 61.8% level. Price reaches that level and then what? It fails to break the level multiple times. So what we are seeing right now is hesitation in the market. Candle after candle after candle, price is rejecting the zone. This is what I call the golden respect. It doesn't mean like, okay, now it's respecting the level, I'm going to enter right away. No, it can respect and then it can drop further. So no, not yet, all right? This reaction doesn't equals a trade, right? Because price can maybe even bounce up a little bit before going that down. What we want is confirmation for our entry, right? So confirmation means what? Candlestick patterns. So for example, a bullish engulfing candle that forms, right? This bullish bar wraps up all the previous bars, that forms, that engulfs it. And a bullish engulfing pattern is already good. An uptrend is already good. Now with the confluence of the Fibonacci 61.8% level, that is like a beautiful, one of the best ratio, the 50 and the 61.8% level. So that is your confirmation. As it shows what? The momentum is now shifting forward with that bullish engulfing bar. So then what? Multiple green candles break above the 50% resistance. That's how we know that the bounce is real. That's your trade, right? That's the combo. That's the combo that we want. Just in case the trade didn't go the way that we plan it to be. And we need another way to save it. That's where we need to place our stop loss. Because every trade, we got a plan. There's always got to be plan B. What happens if it doesn't go up? So where do we place a stop loss? Just below. It's going to be simple. That's where the RR is so good. Just below the swing low itself. So now, for your profit target, simply, generally speaking, you can set it at the 0% of the Fibonacci level. I want you to remember this. A Fibonacci that touch doesn't mean anything. A Fibonacci that respects the level means everything. So the golden respect rule is how you separate all the signals from the noise. It's where you cut out the false trades and then you add in the confirmation for a real setup. So now, you know what's interesting? So everybody is always talking about, okay, I'm going to enter here. Here's how you enter. How do you enter? This and that. Everybody is talking about entry, right? But what most people, they don't really talk about, which is like the most important thing actually, is the exit. The exit is the one that determines whether or not you make money or how much money you make.
You may say, hey, Ezekiel, I already nailed the entry, right? So shouldn't the trade manage itself, right? It's clear cut.
But here's the thing. Good entries, yes, they can make you money, but the good exits are the ones that make you a lot of money, right? Because if your exit is not measured, you are probably leaving a lot of profits on the table itself, all right? So this is where technique number 3 comes in. Quick pause. If you found this video helpful so far, here's something that always surprises me. 73% of you who watches this video regularly haven't subscribed yet. I mean, if you're getting value and want to support what we are doing, the best way is just to hit that subscribe button. It's free and really helps us to continue creating better content for you every single week. It truly means a whole lot to us. Okay, now let's get back to it. I call this measured because that is how your exit needs to be measured. Not just like mathematically, but also mentally. You don't always need to close 100% of your position at one target itself. When done right, scaling increases your edge. to make more in the market itself. Now, let's say in this example, price bounced cleanly from the 61.8% level, right? And then like what we talked about earlier, right? We take partial profit at the 0% level, right? So what? That locks in your gains, right? But it doesn't end the trade yet, because why? We only take partial profit, and you let the rest of it run if the momentum is still strong itself. In this example, right? Price broke through the swing high after a clean bounce. If you exited too early, you will miss the entire follow through, after which there is a lot of money left on the table itself. And we waited so long for this trade to only get out for just a little bit? No, it doesn't make sense at all. So exits are the key, and it should be guided by what? Structure, right? You exit the market because what? The market shows signs of exhaustion. So take a look at this. Multiple green candles, right? So then price starts what? It's stalling near the 0% level. And all this what becomes what? Small bodied candles, long wicks. So it means what? That the momentum is now fading off. So this is not panic anymore. This is the structure talking to you, right? And the structure is kind of telling you, hey, I'm tired. And if the market is telling you that I'm tired, you listen. And that's where you decide like, okay, it's time to get out. That's where you got it, right? You learn to exit with structure. Because taking profit is not about, okay, having a standard take profit. There are times whereby, and a lot of times where you notice you actually left a lot of money on the table itself. And that is the difference between a profitable trader and a very profitable trader. Now, here's the best part. You know how to plot the Fibonacci level, technique number 1. You know where to enter. You know how to exit now for maximum profits. I'm going to take it up a level for you. That's going to increase your probability of the trade working out. So instead of just adding the Fibonacci retracement level, which is vertical, right? Because it's from high to the lows or the lows to high, which is the vertical Fibonacci levels. I'm going to add now another Fibonacci tool that is horizontal. And when the horizontal meets the vertical, I tell you, this is going to increase your probability by a whole lot. All right. And this is where technique number 4 comes in. Unlike the usual Fibonacci that deals with price level, this one deals with time. It's like you're putting a clock on your chart itself and watching how the market respects the time. So Fibonacci time zones use the Fibonacci sequence, not on the price but on time, right? It projects out key dates or the candles into the future. So it adds the what? Timing precision to what most traders use, where most traders only use for price, right? So when the time and the price it aligns, you get a super high probability window, right? For a reversal or a trend continuation. Take a look at this. There are millions of traders out there, right? Using different time zones, different swing points, different styles. The time zone depends on how you see the market, right? It's not guaranteed, right? But it gives you what? Another layer of insight. Take a look at this chart. We have a clear swing high during the session itself, right? And then a swing low, right? So then we use the Fibonacci time zone, the tool, and we put it on and we anchor it from that swing high to the swing low itself. So this tool will now automatically mark vertical lines into the future based on the Fibonacci intervals. It's not guesswork. It's also based on Fibonacci structure, right? 1, 2, 3, 5, 8, 13, etc. Each line basically becomes a potential time point and what we call a K point, where a reaction might happen at that point. Not guaranteed, right? So just a moment in time where that at the area where price could reverse at their levels or accelerate upwards or downwards. So what do? We watch how price behaves around those time levels itself, right? So take a look at this, right? On the first K day, right, we got a reaction. Price reverse. And then on the second one, continuation. And then another one, a sharp bounce. So, and some gave it a what? An increase, right? And then a downwards movement. So the market respond right on the time itself. It is interesting, right? Market responds on the time, right? So this prediction using Fibonacci into time zones. We don't just trade it blindly just because, oh, likely at this time, something is going to happen. No, if you understand how the whole market structure works, why certain timing the market moves because the traders come in, why certain dates the market moves because of certain events. This is where you recognize that Fibonacci time zones is important as well. So it will not tell you the direction, but it tells you when to pay attention to it. Here's how you combine them together. First, use technique number 1. You plot the high and low using the Fibonacci retracement level, right? Then you now plot the Fibonacci time zone where price is likely to react. So then what? When price goes to the exact Fibonacci retracement level that matches the Fibonacci time zone, that matches the golden respect rule with a candlestick confirmation, woo! This is going to be an awesome entry. Then you enter the trade and you use the measured exit technique to get it out. Good. This is how you put everything together. And when you add these 4 techniques together, they are no longer like tricks. Oh, this one trick, this 2 trick. No, this is not a one-off setup anymore. This is now the complete Fibonacci trading flow. All right. So the next time you pull out a Fibonacci tool, it's not just lines anymore, right? You know exactly how to trade it with the highest probability level. Okay, so here's what to do next. I want to give you something that's going to change the way that you trade forever. So I've put together a free training that walks you through the exact 3-step system that I use to find high probability trades with sniper level entries, real risk control, and zero guesswork. So this is the same system that I use myself, and the same one that has helped thousands of traders go from frustration to consistent wins. And I'm giving it to you for free, right? There's no fluff, no fueler, just pure strategy. So if you ever wanted to trade with clarity and real conviction, this is the place to start. So click on the link in the description below and I'll see you inside the training.